Good morning. God bless. Grab a strong cup of coffee and maybe put it in your XRP mug because we have XRP up against war, the yen carry trade unwinding, which is part of a global margin call, and we're also still battling the banks on getting crypto regulations passed, the update on clarity and where we're at with it. Everything in today's update. You're not going to want to miss it. Make sure you guys have subscribed and hit that notification bell. If you are new here, we got a spike in oil. Markets are back down. What the heck is going on? Let's break it down. President Trump this morning says that there will be no deal with Iran except for unconditional surrender. And it appears that this was the big catalyst that spooked markets, sending them back down and shooting oil back up. And so President Trump coming out here, and this was after yesterday there was a bipartisan bill to actually stop any more strikes in Iran. This was submitted by Representative Ro Khanna and Thomas Massie, bipartisan, and this was struck down by the Congress. And so these strikes are going to continue. The war will continue for now, and President Trump says that there's no deal unless we get unconditional surrender. And I believe that this war, there's a couple different reasons why it's taking place, but I'm just going to mention here that it's doing a fantastic job of covering up that global margin call, the devil in the details of our economic data. And this is what I'm talking about right here, folks. The second largest monthly job loss since the 2020 simulation. We lost 92,000 jobs in February. The expected gain was supposed to be 55,000. So a huge miss on our monthly job numbers for February. Oil prices are up 60% in 4 months to a 2-year high. Gas prices up more than 20% since December 2025. U.S. producer price index inflation unexpectedly rises to its highest level since July 2025. We've been saying that inflation's not going anywhere. It's going to kick back up again, especially with this war. They're requesting $50 billion from Congress to continue funding it, with some talks of it even extending until September. All inflationary. You better own assets or you will be left behind. The 10-year note is now up 20 basis points this week. So if you thought those rates were coming back down, even if the Fed does cut rates here in March, they're battling a bond market that's given us the middle finger. $600 billion in expected AI investment from Magnificent Seven companies in 2026. But the question there on the AI play is, will the private credit market blowing up, is that going to kind of dry up the spigot, the flow of liquidity that was coming in to finance some of these software, some of the build out, the hyperscalers? If that dries up, are we going to be able to continue this AI boom and expansion that we've been going through? And really, the AI build out has been covering up the poor economic data on Main Street. Now, how bad is it out there if BlackRock, the largest asset manager in the world, is limiting redemptions on one of their private credit funds as outflows swell? This is reporting from the Financial Times here today. And so we're just stacking it up, right? First, there was a couple small fries, a couple small players. Don't worry about it. It's not systemic. It's not an issue. I remember talking with bankers at the Ripple Swell conference in November, and I asked them straight up, hey, Moody's, which actually was funny, Moody's was actually speaking at Ripple Swell as well up on stage. But I said, hey, Moody's is in the room here saying that private credit, they just put out a report saying that it's not too big of a deal, not too big of an issue. What's your thoughts on this? And they said, oh, no. Yeah, private credit's an issue. We can't tell how big it is going to be yet, but there's a problem there. Is it as bad as the Great Financial Crisis? Can't say yes or no, but there's an issue. And now my opinion is that all of this combined is worse than the Great Financial Crisis. See, it's not just mortgages and mortgages getting wrapped up in credit default swaps on the mortgages and everything that we went through with the Great Financial Crisis. It's worse. Now, is it 10 times bigger? Is it 100 times bigger? We don't know, because of a lot of this being wrapped up in private funds. And that's going to be private equity, which has gone into private credit. And a lot of it is off balance sheet, different derivatives. And then what they're doing is they're putting bad debt, toxic debt, and loans in different shell companies outside of U.S. reporting standards. So basically, what a company will do is, and this is being done in the life insurance space. I just watched a whole video, a podcast by Steve Eisman. I recommend you guys go check out his new podcast that he's been doing. Is fantastic. A lot of times people ask me, who do I watch? I don't really spend too much time watching other crypto content creators at all, but I watch other people that speak more broadly on the financial markets so that I can understand the broader financial markets. Steve Eisman, he was one of the players involved in The Big Short, but his podcast, spectacular, and I recommend you guys go check it out. He just did one talking about private credit, talking about life insurance companies that are getting regular retail people to have, pensions and other funds, their retirement funds and investments in their life insurance policies wrapped up in some of this private credit. And what they'll do is the U.S. company, the U.S. entities, they have to report, what they're holding, the good, the bad, and the ugly. So what they'll do is they will package up the debt, the bad debt, other loans, other liabilities, and they'll put it into shell companies, essentially, off into the Caymans, Bahamas, and others outside of U.S. jurisdiction where they don't have to report it. So on the surface, you're looking at these U.S. entities and you're saying, wow, this is strong. A lot of assets, not much in liabilities. 2 + 2 still equals 4, right? Right. But what's missing from that equation is the offshore balance sheet of toxic derivatives, liabilities, and credit. And that's where the real exposure can pop this without us being able to observe it, because it's all offshore. Now, this is from UBS, so don't take it from me. I'm just a Joe Blow. But U.S. private credit default rates could reach levels not seen since the financial crisis. In a worst-case scenario of rapid AI disruption, UBS projects U.S. private credit defaults could hit 14 to 15%. Now, the pundits are saying, and other talking heads are saying, don't worry. Which, every time they say that, makes me more worried than I already was. They say, don't worry about this, because 14, 15% in private credit, it's not great financial crisis level. It's not as big as the mortgages were. You have nothing to worry about. It's like the government saying, hey, we're here to help you. Knocking at your door, we're here to help you. The problem is that this isn't the only issue. This isn't the only domino that's going to fall, right? As this global margin call unwinds, there's many facets to it. Private credit's only one. Now, the appeal for private credit was this. Private credit anecdote from Edward Dowd. I advised a friend a year ago with $500,000 burning a hole in his pocket. He was pitched a middle market BDC fund yielding 8%. He was focused on the monthly dividend check. I said, quote, first, that yield is too high and means that there is risk there. Secondly, we are late in the credit cycle and you risk losing principal and liquidity. Why don't you roll 3-month T-bills at 4.3%? He did, and he's happy now. So this is what's enticing, is these private credit deals, you're yielding 7 to 8% monthly dividends. And that's the story, that's the sales pitch, compared to 4% on your T-bill. Your risk-free government-backed T-bills yielding you about 4%, put up against these private credit deals where you can make 6, 7, 8%. And they might not be as liquid, but there hasn't been any issue, right? Up until now, everything was going fine. The music was playing, the drinks were flowing, and we were having a great time. Until now. And now you start to see with small little shrimp in the big sea of private credit liquidity, we got small little shrimp that are going bust. And I say maybe not going bust, halting redemptions. See, it starts with a few halting redemptions, and now it's starting to expand to the largest asset manager in the world, BlackRock. And I was listening to Blackstone's COO and president on CNBC the other day talking about how they were handling their redemptions and how it was actually a sign of the strength of their product. The fact that there was like almost 10% of the fund wanted to redeem and pull money out, that was a sign of strength. These guys do a good job of selling you. And so the issue here is that this is now unwinding, all part of the global margin call. What's going to be the solution? They have to drop interest rates, they have to turn back on the money printer, and they have to start buying back their own debt. And the U.S. Treasury is doing it right now. We've been talking about this actually since the end of 2025, where the buybacks from the Treasury really picked up. U.S. Treasury buybacks another $2 billion of their own debt, now $4.5 billion total this week. I mean, it's already tens of billions, hundreds of billions, probably if we tally up the past few months, December, January, and February, massive amounts of Treasury buybacks. The Federal Reserve also injecting liquidity. Now, they don't call it QE yet. Right? And you see where this is going? All of this is being covered up by the war in Iran. See, mass fear, mass propaganda, the fog of war. I don't trust anybody, by the way. I don't trust anyone right now. The fog of war is real. And the West is lying. The United States is lying. Iran, Russia, China, everybody's lying. But the numbers don't lie. At least the numbers that we can verify. And that would be the buybacks that we're witnessing right now. Now, we're also up against this yen carry trade. And you guys are probably already aware of how this all ties in together, right? Where Japan, they're very reliant on bringing in energy, bringing in oil, right? And they've been battling inflation. They had 0% rates for decades. Now their rates have gone up. And so they're trying to combat inflation. But this war really kind of escalates things. And so to get a real snapshot here of how much of the yen carry trade has unwound, this carry trade that by some estimates is into the tens of trillions, how much of it has actually been solved is the question that we're asking here today. Michael Guyad, huge shout to Michael, had him on the show last year, and we're working on getting him back on the show again. He's a very busy guy, manages ETFs. But how much of the yen carry trade has unwound? In the speculative futures, it's about 85% cleared, so that's good. Hedge fund forwards, about 20%. Okay. Japanese insurers and pensions, only about 5%. FX swaps, only 3%. So the weighted average is about 8 to 12% total. The visible layer got flushed. The $4 trillion structural layer barely touched. And he put together this chart, very well done by Michael. And so how early are we in this whole game? We're still in the first couple innings, which is the siren should be going off. And you should be asking yourself, who am I exposed to right now? Right? Where's my counterparty risk? Now, do I have any counterparty risk when I hold my silver in my possession? No. Do I have any counterparty risk when I hold my XRP in my self-custody wallets? No counterparty risk. And then the limited amount of counterparty risk that I do have, I mitigate that by making sure I'm using platforms that have bankruptcy remote protection, yada, yada, yada. You guys know the story. We have all those linked up down below and at my website, zachrector.com. But the solution of all of this is to bring it on chain. Private credit, all of the yen carry trade, we can't tell how bad it is because it's not on blockchain. A lot of off-balance sheet derivatives. They cover it up. Shell companies in the Caymans, etc. But when you bring it all on chain, then we can track it all. Then we can trace it all. And then we can see who's holding what. And here's where the solution comes in. And we're making progress right now, despite the banks holding up yield. And we might not get Clarity Act done this year. That's where we're at right now. The banks have drawn a line in the sand. They want to bully us. They are pathetic. They don't want to give up their profit. And they're willing to sacrifice this rollout. They don't care because they're the incumbents. They control the system right now. So they're not in a hurry to rush this out. This buys them more time to set up their systems. But in the meantime, the banks are holding up Clarity. Congress is stalled. Congress has to deal with war and a bunch of other stuff too on top of crypto. So that's a problem. But the good news that I have to deliver for you guys, yes, I do get to end today's show on some good news, is that the U.S. OCC and other government agencies are progressing, providing guidance, like the SEC providing guidance to stablecoins, where you now only have to take a 2% haircut on stablecoins. That's massive. The other one that we got from the OCC is that tokenized securities will be treated the same as non-tokenized securities. But Eleanor Terrett points out this interesting nugget. Under the Biden administration, regulators often treated permissionless blockchains as riskier than permission ones, resulting in different regulatory treatment. Here, they are treated the same. So the USOCC came out yesterday and said that eligible tokenized securities should be treated the same as non-tokenized securities. Fantastic. But another interesting nugget that Eleanor Tarrant pointed out right there is that permission blockchains are going to be given the same risk tolerance as permissionless. We always said that. This idea that because they're permissionless means that they take on more risk, not necessarily true in all cases. This is great progress. And so the SEC, the CFTC, the USOCC, they're all moving forward and giving guidance while Congress drags their feet, while the banks stall up everything on the Clarity Act. And that's the good news, okay? And the good news is that we're in the right asset. Crypto is here to stay, and it is going to boom once again. I know it's hard to believe when you're in the depths of these bear markets, but taking a quick look at the charts, this is why I'm taking advantage of these low prices. The market came back down today as I expected. I wasn't buying the rally that we had over the past couple days earlier this week. And so we finally get this spike in oil up to $90 on the WTI crude oil. So that's fantastic as far as, things moving along and escalating here. But the Dow Jones back down. And this was the rally that I said I didn't trust. When we got this bounce to this low on Tuesday, and then we got a little relief rally back up here to 48,000, this is what I was saying I didn't trust. For crypto, it was Bitcoin back above 70,000. For XRP, it was back up to $1.45. I said I didn't trust it. Sure enough, boom, back down we go. Unconditional surrender is the only thing that we'll accept, and that's what triggered this morning. NASDAQ 100 still in the green today, but cooling off. S&P 500 about to go set a new low. The Dow Jones already did it. Russell 2000 already did it. New low. VIX spiking. This is where we get into trouble. Watch closely. Bitcoin. I didn't trust the rally up to 74,000. Here we are, back down to 68.2. Yes, my red target's still down here. It might take some time. If you go back and look, November 8th, 2022, FTX blows up on the full moon lunar eclipse November 8th. It took 13 days for Bitcoin to go reach the final bottom. So that's why I extended my red target out a couple days past the Tuesday, 3/3, March 3rd, full moon lunar eclipse. It was a blood moon. And I said, hey, it might not be the exact day, it could extend. And sure enough, this war really escalated this past week. And we see that, Bitcoin's back down here to 68.2. And we see that XRP, despite popping up to $1.47 earlier this week, is now back down to $1.35. And I think that the final bear market low is coming in for XRP here shortly. I've added additional buy orders. I'm going to be taking advantage of this, not just on XRP spot, XRP long. I'm also added to a couple other bags too as well. So I got my orders placed. I still think that we get a pullback. The climax of this war, I don't think that we've hit it yet. So I think that that's what draws us in. You saw what happened here this morning. President Trump makes one statement: no deal, unconditional surrender. Markets all come back down. We're not in the clear yet. I'm not getting too greedy and trying to wait for XRP to go down to 50 cents or even $1. I'm front running all these levels of support between here and $1. And I'm also looking to add to other positions with real utility. Digital assets are here to stay. Digital assets and blockchain technology is the answer to all of the issues that we've laid out in today's episode. Private credit's blowing up. This carry trade's blowing up. All part of a bigger global margin call. Even war, for crying out loud. You need a solution to prevent World War III? Neutral reserve currency is the answer. Gold plays a role. I believe that XRP plays a role. You guys let me know in the comments down below what you make of everything that's taken place this week. If you guys are looking to get access to our private community and our weekly Discord call tomorrow morning, that'll be at 11:30 a.m. Eastern. You sign up through Patreon to get access to Discord. That's how you join us in our private investment community. If you appreciate what we're doing, please help us out by liking this video, and we will see you guys in the next one. God bless you all. I am your host, Zach Rector. I really appreciate all of the love and support. If you want to support the channel, just remember that you can start by smashing that thumbs up for me, sharing this content far and wide, and everything else is at my website.